Guys, welcome back to Count Nova. And today's topic will be the continuation of the statement of cash flows. So let's not wait, let's just start off. So, as discussed in the previous part, we had discussed about statement of cash flows. What is statement of cash flows? What are the components of it? What is operating activities? And what are the cash inflows from operating activities, cash outflows from operating activities. These were the discussed topics in the last session, and today we will be pitching into non-cash activity. As said, still we are in operating activities. Don't get confused. Non-cash activity comes under operating activities header. What is non-cash activities? See, non-cash activities are those expenses or income that are recorded in the P&L accounts are accrued as such, accrued or deferrals will come under non-cash activities. Let's take an example of a non-cash activity. So say there is depreciation. Depreciation is one of the greatest example of a non-cash activity, correct? So if you are depreciating a asset, is there any cash that is the company is paying to somebody? No, correct? There is something called as amortization. People ask what is the difference between amortization and depreciation? Depreciation is for tangible assets, amortization is for intangible assets. This is the basic difference between these two. So again, in amortization, when the company deducts the money of amortization or depreciation, there is no actual cash going out, correct? It's just a kind of a wear and tear in the value of the asset, but there is nothing like a cash that is being paid by the company as an expense regards, correct? And also, loss on sale of asset or loss on sale of asset is a non-cash expense. Understand? Gain on sale of asset is not a non-cash expense. Write it down. So what I am saying is, so for example, I have one asset. Okay, it was for $1,000. Okay, so the accrued or accumulated depreciation was, let's say it was for $400. So the net book value was $600. Now what I made is I sold this asset. Let's take a scenario one. Sold the asset for $800. Second scenario, sold the asset for $400. So in scenario one, I have made a gain of $200. Here, the loss is $200. Now, when it is a gain of 200, I am receiving a cash here, correct? Somewhere I am receiving a cash, correct? or 800 rupees. Even though the accumulated depreciation is 400, this will be treated as a non-cash expense. But this 800, that's the extra 200 that you got, you would have received the cash for it. So this is a cash operating activity. So this will be deducted from operating activity but added under financing activity. We'll get to know it. But for now, since we are discussing about only the operating activities, so the gain will be deducted from the operating activities as cash inflow. So this was a cash inflow, and we will be deducting under the header operating activities. But loss on sale of asset is a non-cash activity because this 200 is nowhere paid. Simple. Okay. So understand the difference here. So let's come back. So these are the little what these are the some of the examples of non-cash expenses that we will be adding to the net income under operating activities. Now we will be subtracting the non-operating gains, that is the gain on asset sale. Okay, so just have this on the mind. This will be subtracted as said uh, in the previous slide. So now there is something called as adjustments of working capital that we may have to do. Okay, whenever the account receivable is increasing, it's a cash outflow. Whenever the accounts payable is increasing, it's a cash inflow. If inventory is increasing, it's a cash outflow. Accrued expenses, cash outflow. Correct? So let's think about this. This could be little confusing for you guys to remember all those. Whether the accounts receivable is increasing or accounts payable is increasing, we have to add it or treat it as a cash inflow, cash outflow. Oh, too much of thing. So here I would recommend to remember only one thing, that is accounts receivable or accounts payable or inventory. Any one. You choose yours. So let's choose only accounts receivable. Just remember this, accounts receivable if increasing, it's a cash outflow. Simple. You know how to calculate working capital. So if not, I think I have to do a separate video on the working capitals, but I'm assuming that everybody knows what is working capital, what are the components of the working capital, what is current liabilities, what is current assets, everything. So basis that, I'm assuming you know it. So you know that if account receivable is increasing, it's a cash flow. So whatever is opposite, make it as opposite. If accounts receivable means, what is the opposite of accounts receivable? That's the current liability. Accounts payable is increasing, then what? It's a cash inflow, the opposite of this. So if you remember one, the others you can make it as an opposite and remember. So this is the adjustment of the working capital again. So sorry, this one. Yeah. Whatever the accounts payable, you will make it as a cash outflow increasing. So how this will be impacting in under the cash. So let's say, so let's come back here. So just imagine we had a sales of $1,000, and in that we had cash credit. Under cash sales, we had around $600 and $400 of accounts receivable. What's up? Accounts receivable. Now, in the P&L account, since we are following accrual basis of accounting, the revenue recognized is this whole $1,000, correct? So you will have some of the expenses here, and you will have some net income as $200 or something, correct? And now you will transfer this to retained earnings in the balance sheet. Yeah. So the net income includes even that amount which is not earned by cash. Even this 400 is included in this. Correct. That's why we will add it. But how we will get to know what is the credit sales of a company for this year? Maybe just imagine by the increase in the accounts receivable. So year one and year two. So year one there was around $200 of accounts receivable, and year two is $600. This is a simple explanation. So obviously, what we'll do, you do this minus this if you have got the balance sheet. If you don't have the balance sheet, then uh, there should be some information about what is the cash sales and credit sales for the particular year, or there should be information where you can calculate this. So there will be confusing things that will be given in the examinations, but we will discuss while solving the illustration. But for now, just think this. So 400 was the if an example gives the balance sheet saying that year one it has 200 and year two is 600, then $400 is the credit sales. So that we will be deducting as a cash outflow from the operating activities under the header, under the header operating activities. Let's come back now. Now, again, this is accrued expenses, that is the cash outflow that you will do it. Okay. So next thing, this is an easy tip. So operating is equal to running the business, profit generating activities. Simple to remember what are operating activities. Operating activities are those activities that are required for running the business day to day and is equal to a profit generating activity. So this is the basic basic understanding of the operating activities. So now the next thing is investing activities. Now investing activities and financing activities becomes more easier. Okay. Investing activities. Investing activities are those activities or cash flows that is related to acquisition and disposal of long-term assets and investments. Okay. These are the expenditures that are made for resources intended to generate future income and cash flows. So, for example, land. We bought a land. It's an investing activity by the company to generate more income. Correct? Yeah. So, cash payments to acquire PPE, long-lived assets. Cash payment to acquire equity of some other company. So they bought. So it's kind of an investing activity. So Debt instruments that are held till maturity or available for sale. Again, it comes under investing activity. So the debt securities which are for trading will not come under investing activity, rather it comes under operating activities. Okay, remember this. Only HTM and available for sale debt security will be under investing activities. Loans and advances made to other parties. For example, I provide a loan to some other company for X and X amount for some percentage. So this is again an investing activity. This is helping to generate some income to the company, whether it could be the from the core business operating business for the core business activity, or uh, it could be a non-core business activity. For example, if I buy a land and put it to a rent, it's under the business name, but generating rent is not the core business of the company. So then it is still giving me income, but not a operating activity income. It's kind of financing activity income, sorry, investing activity income. So just imagine, just keep in mind that payments to acquire PPE, long-lived assets, to acquire equity, HTM, loans and advances to other parties. So these will make income from investing activities. Okay, so here you should understand that whatever the gain, whatever not even not the gain, sorry, the cash receipts that I receive. For example, I sold this asset, right? I sold the asset. If you remember, we sold the asset here. We sold the asset here for 800 and 400. So the entire receipt amount, I'm saying, the whatever the amount we have received will be recorded under investing activity. It is not divided by gain or loss. Only the amount that we received via sale. For example, understand we have an asset of $1,000 again. I sold it for with a net book value of $600. I sold it for $600. Sorry, let's not make it no profit, no loss. We'll make it as $400. So there is one more scenario, sold it for $800. Now, same in operating activity, I record only the loss, right? Loss, I will add 200. In operating activity, I will add the gain that has got. So I'll be deducting in operating activity. But whenever I'm recording it in the financial activity, I will not separate the gain. I will not separate the gain or the net book value. I'll directly give the financing activity income. I'll add that 400 back here. So I'll add this 800 back here. So the net effect will be, just imagine, 6, correct? What would be the net effect? 400 plus 200, 600, 800 minus 200, 600, and that was the book value. But the presentation was quite different. So it was helping the shareholders what I am getting from operating activity, what I am, what is the company doing with financing activity, correct? So understand that in operating activities only the gain or loss is recorded. In financing activities, the receipt of the total amount that you have received will be calculated and subtracted or added basis the activity. I mean, if you are buying, it will be a minus. If you are selling, it will be a plus, because if you sell, cash is inflowed, it's cash outflow. Again, remember, it should be cash inflow or cash outflow. Should not be a credit basis, should not be a accrued basis. It should be simple cash, cash. Got it? So this is about investing activities. So we will cover the financing activities in the next class. Until then, please revise, and if you have any questions, drop the comments. I'll be replying to you, or drop an email at accountnovat at gmail.com. That is in the description, or in the description of my channel. Until then, take care. Goodbye. Signing off. Account Nova.